Is real estate a good investment? This is far from a simple answer, as there are a variety of different factors that come into play. Location, cash flow, appreciation, migration patterns, town population, income per capita. These are all crucial factors to consider when determining if real estate is a good investment. With any investment or potential for profit, there comes risks. In this video, I'll be going over if real estate is a good investment worth the risk. I'll be posting every Tuesday and Friday, so make sure you check back for future content. And also make sure you go ahead and like and subscribe, smash that notification bell so you can get notified whenever I post any video. It's very difficult to make a blanket statement if real estate is a good investment, like any investment. With any investment, it's important that you do your own due diligence and determine if real estate is a good investment for you as an individual. With that being said, let's talk about real estate as an investment. In order for us to decide if real estate is a good investment, it's important to determine what is a good investment. A good investment can have many factors, but in general, it boils down to three. Those three would be protection of capital invested, liquidity of capital, as well as cash flow. When it comes to investing, it's extremely difficult to have all three. It's generally a scale, sacrificing one factor for the other. Real estate is no exception to this. When weighing real estate on the scale, different properties will stack up differently in each of those three categories. For example, a prime piece of real estate on an oceanfront or in a major city may offer preservation of capital, but will be limited in liquidity of capital invested. The reason for this is because a sale of the property would be a long, drawn-out process, versus an investment in a stock in your Fidelity account would offer easy liquidity. It's easy to sell and it's fast, but might not offer that preservation of capital as it fluctuates daily and the price of the stock can very quickly drop below what you paid for it, costing you your initial investment. So these are the differences between real estate as well as stock invested. One offers liquidity, the other one has a more solid preservation of capital. In general, real estate is more likely to offer that preservation of capital. Now, there obviously are some exceptions to this. For example, if you invested at the end of 2022 in Austin, Texas, Boise, Idaho, Myrtle Beach, South Carolina, or Phoenix, Arizona, then you could have lost 5 to 8% of the total price of the property in 2023. Now, when you invest in real estate and use leverage, everything's magnified. So if the value of the property decreases by 10% and it's $500,000, that means that $500,000 property is now only worth $450,000, and that can cut your initial investment pretty quickly. Now, source considered, obviously, Austin, Texas has appreciated on average of 10 to 11% over the last 10 years. So length of time that you plan on holding the property can reduce your risk, but I just wanted to outline both sides of the scenario. And also, please consider that we're talking about Austin, Texas. We're not talking about the middle of Antarctica with a population of 50 people where the possibility of appreciation is already slim because there's not many people itching to move there. Additional ways that you could minimize risk of depreciation and protect your initial capital invested would be studying migration patterns, income per capita, as well as comps on the property that you're planning on purchasing. Comps prevent you from overpaying for the property. Migration patterns help make sure that there wasn't any recent influx of people moving into the city or buying, because what comes in quickly can very easily go out quickly, which could cause depreciation in the future. And then income per capita review would help you buy for the average sales price. What I mean by that is what the average household income in the area is can help you figure out approximately what the average population can afford for rent. So to figure this out, you take the gross average household income and divide it by 12 to get you the monthly income per household. You then divide that by 2 or 3 to get the average rent in the area. Maybe not average rent in the area, but more so what the average household can afford for rent, I should say. Answering if real estate is a good investment really boils down to what you're trying to get out of it. Want cash flow? Then maybe look at a place with a high population, make sure you consider the comps, then buy a place with low operating expenses, minimal debt on the deal, and high rents. The low operating expenses ensures that you'll have minimum outflow every single month. The minimal debt on the property means your cash flow isn't getting eaten up by principal and interest payments. And then the high rents or potential for high rents mean that you have the margin to amplify cash flow. All in all, these three mean ample cash flow. Want capital preservation? Then maybe look at a property that is below replacement costs in a great location, under comp value. Real estate with this criteria tends to hold value really well. If you want liquidity, then real estate might not be the best option for you. Real estate is purposefully not liquid. It generally takes at least a month to sell your property, and then bigger, more expensive properties can take many months to sell after due diligence and inspections and all that good stuff take place. Make sure you go ahead and like and subscribe. Thank you so much for watching. If you're interested in how much passive income I make off of the real estate I own, go ahead and check out the video right over here.